Here's what's coming up on Strategic Wealth with Matt Dickett.
Clients are concerned, others out in the community are concerned right now with all this volatility in the market. Where the stock market is off basically to its worst start that we've ever seen. It seems like it's up one day, down the next, but the overall trend seems to be lower.
Well, if you have mutual funds within your portfolio, I think you'd be pretty surprised as to what's actually going on. If you'll follow me over here to the board, I'm going to show you a couple of things.
Guys, we're getting a lot of questions, phone calls into the office. Clients are concerned, others out in the community are concerned right now with all this volatility in the market. Where the stock market is off basically to its worst start that we've ever seen. It seems like it's up one day, down the next, but the overall trend seems to be lower. So for clients that are retired or soon to be retired, what type of message is it that we want to make sure that we're sharing with them and getting out there?
Yeah, for one, things that used to work. I mean, years and years ago, people had things, everything was in mutual funds or stocks or CDs, things like that. Well, now things have changed. They need to make sure that they're updating their portfolio with tools that work today, where they're protected from downside volatility and this type of market, but still get some upside potential.
Jordan, I think probably the worst thing individuals could be doing right now is listening to advice from individuals, whether it's friends or family or other brokers or advisors, that they're saying things like, well, just ride it out. It's just a bump in the road. It's no big deal. The market's going to bounce back. It always does. It's just a paper loss. Don't look at the statements when they show up. You're getting stressed out about it. What would you say to somebody like that that's thinking, well, I maybe had a certain dollar amount. It's come down a little bit. Now maybe it's hit the bottom. I want to wait till I get back to even. I mean, what kind of response do you have to that?
I'd say that's a dangerous game to play. If we look at what's happening in the market right now and what probably will be happening, I think it's going to continue, like you said, with this downward trend and hoping that your money is going to come back, which it could, but with probability and things like that, it's probably going to head in the other direction, and we could see some more losses, which it's a dangerous game.
We recently had a client come in the office, and they 2 or 3 months ago, they were, let's just say now for round numbers, they were at 200,000. They dropped down 10 or so thousand. They wanted to wait until they were back to even, and where are they at now? I mean, they dropped down another 10, 12% from where they were. So you can't hold on to that thought of getting back to where you were when we're going through this type of volatility.
Yeah, well, one of the things we always point out is when you see this type of volatility, if we go through a correction, a true correction, that means that we're going to take about 7 years just to get back to even, on average. Some years it's longer than that, or sometimes it's longer than that, sometimes it's shorter than that, but the average amount of time it takes you to recover from a correction is 7 years. So I think even if the markets have been a little volatile, and maybe you're down a few percentage points, things of that nature, it still makes sense to get a little bit of a safety net underneath the account. And one of the things that I always talk about is you hear individuals say they don't want to lock in a loss, right? So you got to wait till you get back to even on paper before you do anything. But that can be really risky. It's a dangerous game to play because the market arguably could go quite a bit lower. We can talk about that here in a second. But what we always recommend is that you do a lateral move. This idea of locking in your loss means you're going to sell it and you're going to move it to the bank. Right? And then you have no hope of recovery. Whereas what you can do is if you have some assets that have gone down a little bit in value, you may be selling them a little lower, but you can rebuy into other assets that are low as well. So it's basically just a lateral move. And then there are other assets out there that we can help with that then would establish a floor. So if things go even further, that's it. You won't go down anymore. But if things get good and it turns around the other way, well, then you're able to recover and you haven't locked in your loss. Right? So there are some historical things that I know that we share with our clients. If we take a look at the 100-plus year history of the stock market, we know that how January goes, so goes the year about 75% of the time. So I think this is really important for individuals to understand. If during the month of January, if the market ends the month lower, about 75% of the time that's going to be a down year that year for the stock market. If, however, during the month of January, the market is higher, then about 75% of the time it's going to be a positive year for the stock market. We all know that we had basically the worst January ever. So obviously it's not a 100% guarantee that the market's going to continue to go lower, but these aren't very good odds, particularly for those that are closer into retirement. So what do? Do they just sell everything off and put it in the bank, or should they ride it out, or what do we recommend?
I wouldn't say sell it off and put it in the bank, but there are tools and there's methods that you can use to at least put a floor underneath of it, like you said, or move it into things that's a lateral move, or other investments that you can get some protection from downside.
And there are a lot of things people are concerned about this year. I mean, obviously, we've seen the volatility. I don't think that's going to end anytime soon. I really don't think happy days are here again, in the economy. Obviously, we've got the upcoming elections. We have a lot of things that people are concerned about. Is there anything particular, Jordan, that you're recommending to them right now?
I would say the big thing to do is let's put ourselves in as safe a position as possible. We don't have a crystal ball. I wish we did, but we don't. And we need to protect the clients that we work with as much as we possibly can. So the big thing is finding a safety net and helping them as much as possible.
Yeah. So I think really what we're talking about here today is if you are closer into retirement, again, meaning maybe within about 10 years of retiring, and you're concerned about the volatility that you're seeing, it's not too late. There still are things that could be done. It's really best, whether it's from us or from somebody else, please go get a second opinion. Again, if you're not hearing anything other than to just sit tight, ride it out, you've got a well-diversified portfolio, in the long run you'll be fine. We don't buy into that type of mentality, and that certainly isn't something we would advocate for those that are closer into retirement. So if you'd like a second opinion, if that's all you're hearing from your current advisors, please give us a call. Thanks again for tuning in to today's show. I have to tell you, Dustin and I have been receiving more calls than normal lately from folks like you because people are concerned with what's happening lately in the stock market. They've simply heard from their stockbrokers to stay the course, don't be concerned, but we're definitely seeing a reason to get a second opinion. Now, a lot of that, it comes down to having a plan.
Yeah, unfortunately, we've seen a majority of cases lately that people have done a great job saving for retirement, but they and their advisor don't really have a plan as to how to structure their portfolio in retirement.
Yeah, and this is especially the case when it comes down to structuring their portfolio for income. Studies today show that if you remain in the typical balanced portfolio, the appropriate withdrawal rate is 2.7%. So if you had $1 million, that's only $27,000 per year that you should be drawing in retirement. That just seems crazy.
Yeah. When we're structuring a portfolio during retirement, you're looking at closer to 5 or 6% withdrawals throughout retirement. That's why we encourage you to give us a call for a complete retirement review.
Yeah, we can take a look at your current portfolio structure and let you know what kind of yield you're accruing, let you know what kind of risk you're taking, and much, much more.
We'll spend some time talking to you about how to appropriately structure a portfolio during your retirement to generate an income where you don't have to lose sleep when the market isn't cooperating.
We also can't stress tax planning enough. A majority of people have saved for retirement, have their assets in retirement plans such as IRAs, 401ks, and etc. And guess what? During retirement, these are your most highly taxed assets. So we feel that it is our responsibility for our clients to find the best strategies to withdraw those funds at the lowest possible rate, or when the right opportunity rises, to shift those funds over to a tax-free asset. So again, we welcome you to give us a call for a free, no-obligation visit for your complete retirement review. We look forward to sitting down with you soon.
As a financial advisor, if you were to come into my office and I were to say, you know what, I'm going to probably underperform the benchmark that you all set for me. I'm only going to disclose part of the fees. I'm going to tell you some of them, but not all of them. And as far as investments go, I'm not going to let you really choose exactly where you want to invest. You probably wouldn't hire me as an advisor, would you? Well, if you have mutual funds within your portfolio, I think you'd be pretty surprised as to what's actually going on. If you'll follow me over here to the board, I'm going to show you a couple of things. So these are 7 of the things that people don't really realize are going on within their mutual fund portfolio. A lot of the top advisors that are out there are starting to kind of stay away from mutual funds because of these reasons. Now, let's just kind of go through the first one. So I won't tell you what I'm investing in. What they're going to do is they're going to invest in whatever their fund manager is putting the money in. So his job is to buy and sell within the account. Now, though he has some guidelines that he needs to try to stay within, you're not really going to have a choice as to where exactly he's investing, he or she is investing. Number 2, I will only share part of the cost. So the way that works is with a mutual fund, there's 2 different types of fees that are going on. So there's what's called stated cost, And then there's what's called pass-through or unstated cost. Now, the way that works is they have to disclose part of their fee. They have to disclose their management fee. But as far as trading costs and things that could vary year to year, they just pass those right through to the client. So they share part of the cost, but not necessarily all of it. Number 3, I will hide most of your fees. So what they do is when you get that prospectus in the mail every year, you all read them, right? Probably not. Most people don't. So what they do is they put the fees in there in a way that I think is kind of unfair. So you may open it and you'll see on page 1 and you'll see one of the fees is, let's just say 1%. Then if you keep on flipping though, you may have thought, 1% doesn't sound too bad, but keep on flipping. Look on page 13 or 14 and then page 22 or 24 and keep on turning in the back. You got to get your magnifying glass out. Page 35 may have another one. What you have to do is you have to add all of these fees up together to understand overall what you're paying on an annual basis. So they do share some of their fees, but what they're doing is hiding for the most part, most of the fees. It's kind of like an iceberg. Most of it's underwater. Number 4, I will underperform. All mutual funds are measured by an outside benchmark. Most of them are compared on how good or how bad they did by the S&P 500. That's the most popular index. And studies are showing that about 80% of the time, mutual funds will actually underperform that benchmark. Now the problem with that is that you could go out and invest in the index for basically little to no cost at all. So there's not really a reason to pay fees when you can invest right into the benchmark for basically no cost at all. Number 5, I am very tax inefficient. Now, what this means and the reason that it's tax inefficient, let's look at a year back in, say, 2008 when the market was down over 40%. Now, it could have been down over 40%, but inside of your mutual fund accounts, if it was an after-tax account, not in IRAs, but after-tax account in mutual funds, your mutual fund could have lost money, but within that account, there could have been some stocks or some positions within that account that made money. So you owe taxes. So you owe short-term capital gains tax on an account that's down for the year. So a very, very tax inefficient manner of investing. Number 6 is you have no clue as to what the price is going to be. So what happens with a mutual fund is, let's just say, for example, that the market starts to fall. Let's say that we're going through a crash and the market's really starting to tank. Well, you call your advisor and you say, I want out of this position. I want you to exit this mutual fund. Well, whatever that mutual fund ends up costing at 4 p.m. that day is the price that you get. So there's no getting out until the end of the day. There's no trading during the day. Number 7, I take on more risk than you think. So what happens is you could have a mutual fund that's called a conservative income fund, or it could be a balanced fund or something of that nature. And of course, you would think that since it's called a conservative fund, that your money is very safe. But what we find is just the opposite of that. It doesn't matter if you have a conservative income fund, it could potentially be in very risky investments. So if you have mutual funds within your portfolio, I think it's important that you're aware of these 7 things. And if you have any questions about whether or not they're appropriate for you, please feel free to call our office and/or visit our website.
When you have confidence in your retirement future, you can live the life you've always imagined. Because of planning, you now have time to reflect on the wonderful memories of your life. You and your spouse finally have the luxury of leisure time together. To spend fun times with your grandkids, sharing the joy of their excitement about life. Smiling at the thought of quality time with your children and of picking up the check. At last you have time to breathe and rekindle the love of your life. Why? Because you imagined what could be. You planned for retirement. So today, you own your future. Imagine what's next. Plan today, own tomorrow. Call Strategic Wealth Designers, 502-412-3354.
There's a really important decision that you have to make when you are out talking to potential experts or advisors to help you with your retirement plans, or maybe you're already working with a current advisor or stockbroker or something of that nature. And what I'm discussing here is you need to decide whether you're going to work with what's referred to as a registered representative or a registered investment advisor. Most retirees and pre-retirees don't really understand that there's a real difference amongst us advisors. Pretty much everybody assumes we all have to act in our client's best interest, and almost every advisor you talk to will tell you that is what they plan to do. But some of us are required to act in the best interest of our clients, and then others of us in the industry are really required to act in the best interest of the firm in which we represent. And what I'm talking about here is fiduciary responsibility or fiduciary duty. If you work with a registered investment advisor, advisory firm, and that's what we are at Strategic Wealth Designers, when we meet with somebody, we have to give full disclosure of not only the good things or the bad things that we might be recommending, so obviously the pros and the cons, and we have to show and prove that if we ever get asked by a court of law or a regulator or an auditor or somebody like that comes into our office, we have to be able to show that we acted in the best interest of our client. We can't say that, well, what we recommended is pretty good for them. We have to show that it was absolutely based upon their goals and objectives, the absolute best option that was available. If, however, you're working with somebody that's a registered representative, which is probably about 70 to 80% of our industry currently, they don't have to act in your best interest. They have to recommend things that are maybe suitable for you, but they don't necessarily have to be the best option. Again, they have a fiduciary responsibility to do what is best for their firm. So the way that you can decide or at least know who you're working with is you can ask the individual, are you a registered representative or a registered investment advisor? I know it's a little confusing because both those titles sound very similar. There's a very big difference in the type of advice you're going to get typically depending on who they have a fiduciary responsibility to. You can also take a look at their business card. So a lot of times on their business card or maybe on their website, it'll say that so-and-so advisor is a registered investment advisory firm, or they'll say that they're a registered representative. We usually recommend that you work with registered investment advisors because they have to act in your best interest, but that doesn't necessarily mean that registered reps don't sometimes do a really good job as well. An analogy that I'd like to use here is this. Let's say that you're planning dinner tonight, and you could go to a butcher, let's say as an example, and ask the butcher for some advice for dinner tonight. Well, they might sell you some things that they have in the shop, and you might have a very nice meal, but their objective is really to find out how much can they sell you of whatever they have there and sell you as much of it as they can. The difference in this analogy would be, well, let's say if you're planning dinner tonight and you were to go and talk to a dietitian. So just like the butcher, they can make recommendations, but what they're probably going to do first is they're going to learn a little bit about yourself. What are your goals? What's your family history? And they're going to probably put together a better long-term plan for you. And really, what you end up having for dinner tonight is maybe one of the least important things. They're just trying to do what's in your best interest. So if you think about the investment world, kind of like, do you want to work with the butcher or do you want to work with the dietitian? I think it's a good analogy that really describes what it is that I'm talking about here. So again, if you have questions about more information about what the difference is between working with a registered representative or registered investment advisor, if you want to know more about what it takes to become a registered investment advisor, feel free to give us a call at the office. We're happy to answer any questions that you might have.
You're on the back nine heading for the clubhouse. Your dreams of spending time with family and enjoying retirement are just within reach. What happens if you end up in the rough? In these uncertain times, it's crucial to be prepared with sound advice. Strategic Wealth Designers is one of Kentucky's premier retirement planning specialists. For a complimentary consultation, call 1-502-653-6080. Strategic Wealth Designers. Plan to retire well. It's your retirement. How will you live it? How will you be remembered?
Will you be able to take me on vacation?
Will you be there for my ball games?
Will you teach me your values? Will you be able to play with me? or help me go to college? How will I remember you?
Have the retirement you dream about. swdgroup.com.
On this week's segment of Strategic Wealth University, we're going to be learning about how we can protect ourselves from another 2008. Now, 2008 hurt a vast majority of people's financial futures. It changed individuals' plans, and fortunately, when the next correction comes around, you don't have to be the victim. Now, I think there are a few different things that need to be considered when preparing for the next 2008. I had a gentleman come into the office a little while ago, and he was telling me how he wasn't going to be affected by the next 2008. And I said, that's great. You know, I love to learn about people's strategies. So I asked him, what have you done to protect yourself? He told me that I've taken all of my money, all of my investments, I've taken everything and I've put it in the bank. Now we talked for a little while longer and this man was retired. And I said that, you know, how are you going to fund your retirement, or what are you going to live off of? He said his retirement assets, which he had moved into savings. And unfortunately, I said to him, you know, you don't have investments that are going to grow, much less keep up with inflation. At the rate you're withdrawing from your accounts, you're going to run out of money in 7 to 10 years. Now, it's never fun telling someone that, but the great thing was that he came in at the right time. Now, this story represents, I believe, one of the biggest mistakes that people make, not accounting for inflation. Inflation on average, and based on the Federal Reserve's long-term goals, is supposed to be 2%. Now, it of course varies, but if you're withdrawing, let's say 5% from your account, you're not including that extra 2 to 3 to 4% of inflation on top of that. So actually, your bank lost 9% last year. Let's do a breakdown on that. You withdrew 5% from your account, but let's say inflation were 4%. Your dollar that year would then go 4% less far. So a typical stock market correction is 20%. Now, if we do some simple math, in a little more than 2 years, your portfolio is going to be in the same situation as your neighbor who is invested in the market if you're losing 9% each and every year based on your withdrawing and your inflation. So what have you really done to make sure that you're not going to outlive your money? Now, the next big thing is having a well-diversified portfolio. The question to ask yourself, or the person that helps you with your finances, is how do I protect myself from total market failure? So how do I protect myself from total market failure? What do I mean by that? Now let's say that another 2008 happens. What do I do to protect myself from all of that volatility? Now, a common mistake that individuals make is thinking that diversification does this. While diversification is great for having a well-balanced portfolio, it doesn't fully protect you from systematic or total stock market failure. A big question that a lot of people have for us is, you tell us to ask our advisors or brokers on how to do this, strategic wealth. Well, how do you do this? And that's a great question. First and foremost, there needs to be a large part of your portfolio that is free and clear from market failure. But it also needs to have the ability to grow when the market grows as well. The next part is making sure that your withdrawals, or the income from your investments, is at a sustainable rate. That's a huge problem that people get into. They withdraw too much from their investments and it quickly depletes from itself. Now, we have at Strategic Wealth technology and sophisticated software that can help you determine the rate at which you can withdraw from your investments. And most importantly, your portfolio will be safe when the next 2008 comes around. Now, if you would like more information on protecting yourself from the next 2008, or just need some help on determining at what rate to withdraw from your accounts, please give our office a call or feel free to check us out on the website.
You made it. Years of hard work, investing, planning, and now you're here. The long-awaited reward you spent a lifetime looking forward to. But what now? After years of growing a nest egg, now you may want to manage it. Use it to fund your dreams. Make it last as long as you need it. And leave some for those you love. So what do? Wall Street continues to be uncertain, and some conservative options have dropped through the floor. How do you maintain opportunities for growth and reduce risk of loss from market changes? That's where we come in. We are financial professionals. From investments and insurance products to tax reduction strategies and guaranteed retirement income you cannot outlive, provided by the claims-paying ability of insurance companies. You've worked a lifetime to get here. Let us help you enjoy it to the fullest. For a complimentary consultation, simply contact us today.
Well, thank you once again for watching this week's show. You know, Dustin, I think it turned out pretty good.
I do too. It was absolutely a great show. If you have any questions, please feel free to contact our office and/or visit our website.
And remember, retirement planning is a journey, not a destination. We'll catch you here next time.